All right, let's focus on some macro cues this morning. India's December CPI or inflation came in lower than market estimates, and that can be a further boost to the bond markets and banking stocks. However, the industrial production index for November was a disappointment. Latha is here to decode all of that data for us. Latha, over to you.
The CPI number coming in at 5.69 is way below the CNBC-TV18 poll of 5.9. Now, being below our poll is less important. It's way below RBI forecast. RBI gives you a Q3 forecast, which was at 5.6. But now we have October, November, December, and the average works out to 5.37 versus RBI's 5.6. So going way below RBI forecast. And the worries were really about veggies. The tomato onion inflation, if you remember, in October, November, veggies have fallen 5% month on month. And even year on year, the fall in food prices, it looks optically higher at 9.5%, whereas food prices were higher 8.7% in November. But this is more a base effect issue. Veggies have fallen, but cereals and pulses are still a bit of a worry. The bigger thing is core inflation. Core inflation has come in at 3.9. If you remember, the RBI's intention, or rather mandate, is to bring inflation to 4%. Core is a very big contributor. If core has come to 3.9, then 4% somewhat looks accessible. Besides all this, we all know that the US PPI numbers, producer price index, came in below expectation, at 0.1% minus month on month. Expectation was plus 0.1% month on month. So all told, now the talk in the market is, will Reserve Bank change its stance earlier? At the moment, the broad expectation is they will change their stance in April, and rate cuts come, only in the second half of the calendar year, like June or August. But now, right now, hot from the oven is a Citi report saying that RBI changing its stance in February itself becomes a possibility, though their base expectation is still April. So all good on the front with US and Indian CPI ticking lower. We should expect bonds to be very cheerful in the near term. The only negative from the macro was the November IIP numbers coming in at 2.4% versus expectations of 3.5%. And everything was negative. Consumer durables, consumer non-durables, capital goods, all of them were minus, contraction. Possibly because November had many holidays and people had overproduced in October. So it could be a one-off, but there is a little bit of cloud over the NSO's full-year GDP forecast of 7.3% with such a dire number, but maybe it's a one-off.
All right, Latha, thanks a lot for that. Bye.